Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
I'm Carol Massar, and I'm live here in Huntington Beach at Future Proof. Barry Ritholtz, by the way, is going to join us in just a few minutes. He's my co-host over the next couple of days, very involved in Future Proof, so he's going to join our discussion in just a moment. Right now, though, I want to get to the individual who's responsible for creating this just a couple of years ago and responsible for putting it on. We're talking about Matt Middleton. He's a former growth strategy director at the media publisher Informa, co-creator of the financial advisor conference WealthStack. He's the founder and CEO of Future Proof and joins us here. And I should say welcome, but thank you for inviting us.
Thank you for being here. It's amazing.
Tell us about this event in particular, because I've been to a lot of investment conferences. Everyone has its certain feel, but this is something different. And I don't know, is it just that it's outside and at the beach or something else?
It's a little bit of everything. So if we created this in 2022 with the original thought being in 2020, if you recall COVID, the events industry came to a screeching halt, right? And so at that time, most in the event space looked at it and said, well, we're going to go digital because content digital makes sense. People aren't going to travel, risk their health, leave their family. And as an industry, we're a relationship business, right? And so FaceTime is really important. So we had this idea very early on that content is important, but more importantly is the networking and the experience. And so how do you create that in a live event setting? And unfortunately, most events that are positioned inside a ballroom or a captive space don't afford you the freedom, the casual nature and tone, right? This is the first event that I've ever wore a t-shirt at in our industry, and it's fitting, right? I fit right in. And so the elements are, it's outdoor, it's casual. You have really interesting senior level people here. They're open to sharing.
Right.
And then we use technology to better connect the industry. So while this event has gotten bigger, if you come as an individual with a key objective, it's likely that that objective will be met either by the people you meet or the content you could attend through the 5 stages.
Yeah, I have to say there is something about things being more casual. I definitely overdressed, and tomorrow it'll be different. I did wear flip-flops over, but having said that, there is something about putting in a casual setting. And while I always do see meetings at investment conferences, it's just everywhere I look. It's people stopping. There's tables. Everybody's sitting down, talking. I mean, there's a lot of activity and interest. When you thought about the subjects that you wanted to cover also, I was asked by my co-anchor who's back in New York, he said, what about the Fed? Is that something, you're covering the important topics that are out there as well.
Yeah, so the majority of this audience is RIA, right? And the RIA is the fastest growing channel within the investment management ecosystem. And so these folks are here to look for how do they develop their business? How do they recruit, retain, right? They want to grow. Access to investment content, yes, it's plentiful here, but it's far-ranging here because there's more than just the investment content that they come for. They want to come for practice management. They want to come for what's happening with technology. And so focus on a very wide swath of content and therefore bring a cross-generational, cross-functional ecosystem versus just the standard investment conference or just the standard, technology conference.
Yeah, because these guys are running businesses, right? One of the guests that we're going to talk about is, legacy, like the involvement. You have got this entrenched firm, and then they've got to think about what happens after either a founder, right, or co-founder, either leaves the firm, sells the firm. You have to think about some of those issues.
They're predominantly small businesses, right? So when you think about this, many years ago when this channel started, these folks were building firms locally. And then it grew, and then they maybe acquired someone and became national. And now they're looking at it, well, I'm in my mid-50s, I'm early 60s. What's my succession plan, right? I want to leave a legacy. I have a team, right? But I also want to retire and relax and enjoy my life as well. And, it's a culmination of all of this. So you'll see at the content here, we'll have plentiful investment-focused content, but we also have estate planning. We also have, technology-focused, right? How to build your tech stack as an entrepreneur. There's over 275, vendors here, and they're not just here, handing out fact sheets like the old days, right? They're there, they're demoing, they're talking to folks, they're basically getting feedback to how to better serve this ecosystem.
How did you know that there was room for another investment conference?
I didn't, no.
No, that's fair.
Honestly, it's a very crowded marketplace. I've been doing this for 15 years.
Right.
My view was, as someone who attended all these events, during COVID, I kind of said, do I really want to, go do this again? Right. Where you go to these events and you're trapped, right? And you're consuming content 12 hours a day. The only time you break away from this beautiful resort is to go get a steak dinner. And to me, that felt not organic. And so the thesis really here, and most people look at it, we call it a festival. It's bright colors. It's everything that is not traditional to our industry. But the real...
It almost has a Barbie feel, hence my pink.
Yes, and my skin tone right now with the sunburn.
Exactly.
But really, when you think about it at its essence, right, the outdoor element is just a way to bring this out, which is we're all humans at the end of the day. And we want to connect people, financial professionals in our industry, at the human level, which means what, right? We want to connect people based on their hobbies, their interests, their lifestyle. We believe that as an industry, if we could find those connection points where you could make new connections or further your existing relationships in a very organic way, well, then maybe we could actually do better at getting business done naturally in our industry and further the growth of all different sectors here. And so that's why you'll see we have a music conference tomorrow. We have culinary demonstrations, right? There's a lot
of food around.
Of course. There's no shortage of food here.
It's a good thing. Having said that, what's interesting too is I think we're going to talk with the CEO of Betterment and thinking about the next generation of investing. And I just even think about the next generation of how we as financial professionals or we as media cover it, that things are changing, right? And like I said, this has got a very different feel, and the approach to what you guys is doing is very different from, I feel like, what's out there.
Yeah, absolutely.
Not to poo-poo or criticize anything that's out there, but you do see an evolution.
Well, I mean, look, what's important here is that we have a multi-generational audience, right? You have folks that are here that we were talking about succession planning. They're thinking about, all right, where's my firm going, right? How do I keep my employees engaged and involved? Or maybe, hey, I'm looking to sell my business.
Right.
And then you have the opposite spectrum, right? You have folks that are sitting here and saying, I'm just getting started. Right, I want to meet folks like Barry. Right, I need to understand.
Barry Ritholtz, by the way, just walking
the crash.
So let me ask Matt.
You were
a quick
busy
question.
Introducing people up on
That's
stage.
That's right. I just introduced the strategists talking about what they see coming in the coming years. But Matt, your innovation, your creativity, your genius really is what led to us doing this big outdoor event. How far can we press this concept? Where are you going to go with this?
Yeah. So I think this event could scale to 10,000, right? The RIA space is rapidly growing, and there's no shortage of people coming each and every year, and there's certainly no shortage of people supporting these types of events, right? So, our thesis is to have an outdoor festival type, very modern approach to conferences, and therefore serve the next generation, right? We want these events to last for the next 10 to 20 years, and therefore you need to think about who you're attracting to it, right? So the generations that we attract are at every stage, right? It's not just we want the CEOs at this stage that, in 20 years, they're not going to be in the business. And so we think about it like that. So going from this event, we announced Future Proof Citywide in March of next year, and that's going to be in Miami Beach. We have several different retreats. We're really taking this future proof concept into an enterprise business, serving the entire wealth and asset management ecosystem.
How about the French Riviera? Where else would we like to go? Anguilla?
Greek Islands.
Greek Islands.
Nice.
How about Bahamas?
Yeah, we're going to be in the Bahamas next October.
I'm just saying, right?
October, Bahamas.
Warm beach. I'm just planting it now. Good luck. Thank you so much.
Matt, really appreciate it.
Yeah, thank you so much for inviting us. The founder and CEO of Future Proof, Matt Middleton. All right, you are listening and watching Bloomberg Businessweek. We're going to get David Kelly up here in just a moment, but I want to turn to you. Tell me a little bit about how things are going so far.
So far, so great. I mean,
this is your event, too.
Yeah. So the funny story with Matt was we were talking. We had done events previously before the pandemic.
Yeah. And
21, things were starting to open up again, and these take a year to plan an event. Hey, we'd love to do an event again. How do we not make it a super spreader event? He's like, I know. We'll do the whole thing outdoors in California.
Which is brilliant.
And it's worked out fantastically. It's so much more enjoyable and so refreshing compared to the usual.
Were you surprised at how well it has done?
There was a lot of skepticism when we first announced this, but we'd worked with Matt and his team for years. I have a great deal of confidence in him.
Yeah.
And I figured, worst comes to worst, we'll land on our face and we'll spend a week in California. That's not if that's your downside.
Don't say that to
me. Right? But it worked out great. That was 4 years ago. This is our third one, and we're thrilled with it.
All right. Well, we're also thrilled to have next to us right now David Kelly, who's joining us. He's the Chief Global Market Strategist over at JPMorgan Asset Management, with us on site at Future Proof. Nice to have you here. You're very involved in this event.
Yeah, really excited to be here.
Well, tell me about the mood and the mood you are having right now, thinking, we've got a Fed meeting, we expect the Fed to do something, but what's the mood? It feels like everybody's feeling pretty good right now.
Well, I think that's right. I mean, it's been a very good year for markets. The S&P 500 is up 18% year to date. Bond yields are down. The economy's doing fine. I mean, it's slowing down, but it was supposed to slow down. Unemployment's low, inflation's come down. So the backdrop is good. I think the financial industry is doing very well right now, and I just think there's a little nervousness that the Fed might somehow, panic on Wednesday and scare people.
Bill Dudley, former head of the New York Fed, thinks the Fed should be more aggressive.
I think
they should have done it probably already.
Well, I agree that they should have started cutting earlier. Yes. But bringing interest rates down is like lowering a piano down from the fourth floor of a building. You need to do it slowly and carefully. And what I think the Fed misses is the fact that initially you cut rates, you hurt the economy.
Why is that?
Because you talk about long and variable lags. There are three very bad things that happen when the Fed cuts, and this is particularly going to be the case if they cut by 50. First of all, you squeeze the interest income of all those American consumers who got money in money market funds, particularly older Americans. Second of all, if the Fed cuts 50, then the thing that's going to immediately happen is on programs like this and all over America, people are going to say, what are they so scared about?
Right.
They must see a recession. They're looking at all these numbers. So if I'm going to hire somebody, maybe I wait a while. If I was going to buy a car, maybe I should put that off. And so people want to wait and see. The third thing that happens, which is terrible, is you're thinking about taking out a mortgage. You're going to take out a mortgage today, you want to wait a while. I think I'll wait a while, right? I mean, if they're cutting 50, they're going to cut some more. The problem is they don't get this. I wish I could get people to understand this. There is a J-curve effect. You actually hurt the economy before you help it. Now, when rates get very low, you're actually stimulating the economy, but you have to wait until you get to that point. And that's what, frankly, Bill Dudley doesn't get. That's what all the people who are calling for aggressive cutting don't get. This economy is fine. Don't mess with it. Just gradually take rates down slowly. There's nothing going on over here. Don't ignore it.
Slight adjustment is
just
what you're
take
saying.
It down. It's a fine economy.
It's like when you're working on somebody's back, right? You don't just jam it in.
They're like, it's like medieval medicine. I mean, the most dangerous thing is when you're told the doctor's going to come to cure you, because they'll probably kill you. I mean, just
amputation,
lay off.
Right?
Just lay off.
So let's take this down a couple of months, quarter point, half a point. It really doesn't matter. It feels like they're way behind the curve. Where do they end up? If not 50, it's certainly not going to be 50-50-50. Where do you see this going by the first quarter of next year?
Well, I don't think they're way behind the curve. I don't think they should have pushed rates up as high as they did. And I think they should have started earlier. But let's not overestimate the importance of all this for the economy. The rates are too high because the economy is basically a good place. And you need to gradually bring rates down to a normal level. And I think normal is probably 3.5% to 4% of the federal funds rate. You need to gradually do that. My preference would be if and I think they use a dot plot, and I think this is the way that they can express this. What I would love to see on Wednesday is 2 dots in 2024 and 4 dots next year. So you're going to take down 50 basis points this year and then another 100 basis points next year. I don't know if we'll see that or not, but I hope that that's what we see. But they don't need to do this aggressively. The damage they did by pushing rates up too high has already been done, but bringing it down too fast will actually make the problem worse.
Recession off the table at this point, David?
Recession is never off the table. But what I'll say is we're not going to get an endogenous recession. In other words, it's not something that's built in the system right now.
Some external shock.
It's got to be an external shock. I mean, I'm looking at numbers.
So do you rule out external shocks?
No, of course we're going to. The history of the 21st century is nothing but external shocks. I mean, that's what happens.
That's true.
And eventually that'll get us. But it is important to realize that the traditional business cycle, that stress is already behind us. The point at which high interest rates cause a collapse in investments. There has been no collapse in investment spending. There's been no collapse in GDP growth either, by the way. GDP is up 3.1% year over year. In the second quarter, we think we'll get about 2% in the third quarter. So there's really no particular problem there.
So last question, why has so many economists got this wrong? Why are so many people expecting a recession that never seems to come?
And just got about 10, 15 seconds.
Well, I think because they listen to the mood rather than read all the numbers. You've got all the numbers imperfect, but you've got to look at all of them in order to get the right mosaic. And the mosaic looks pretty good.
All right, going to leave it there. Great stuff. David Kelly, thank you so much. David Kelly, of course, of JPMorgan Asset Management. Folks, this is Business Week. We're at Future Proof in California. Carol Massar, Barry Ritholtz. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Carol Massar along with Barry Ritholtz reading in. You're a busy man at these events.
I run around, I do a lot of things, I wear a lot of hats.
He wears a lot of hats. You know, he also does, of course, Masters in Business.
Yeah.
At the Money.
Yeah.
You run Ritholtz Management?
Ritholtz Wealth Management.
I forget what your title is officially.
$5 or so billion.
5 or so, right? And then
real money.
Real money, which is why he's a great co-host to have during this event, because we are talking about the management of real money, a lot of it. Want to get to our next guest, because we're delighted to have with us Scott Danner. He's head of the legacy division at the employee-owned independent wealth advisory firm Steward Partners, responsible for over $37 billion in client assets as of, I think, August 2024.
That's some real money, $37
real
billion.
money.
Yeah.
Firm founded about 10 years ago by former Morgan Stanley Barney managers.
Huh. So you have to explain
Smith Barney, like who are these firms?
Yeah, real firms. Smith Barney was a giant. So legacy division. First question, what does that mean?
So legacy is that next generation. You know, if you think about it, the succession epidemic in our industry is that the average age of advisors, successful advisors, is 58 to 62. And there's a challenge. What do they do when they're ready to step down? And there's a major gap. There are more 80-year-olds than 30-year-olds in our industry. And that's changing. You could see it here. But legacy division is, we had Freedom Street Partners, our company. Mm-hmm. We were acquired by Steward Partners last year. So I went to market, brought our company. We had $3.5 billion approximately, a good size real money firm as well.
Right.
But we needed that next level, and Steward had not done acquisitions. So we now come in as the mergers and acquisitions division. Legacy just means that next generation, that legacy division where we can help people that are looking for that next step in their practice or the final step.
Were you thinking about it when you sold your firm to Steward? Like, were you thinking about legacy as well?
Yeah, so this is what we specialized in.
Yeah.
So it's something that we had been doing. We built an entire model in and around that next chapter.
Right.
Legacy. We used to say, our job is to make you look like a hero on the way out, and we need to look like the hero on the way in to help you and your clients have continuity. So doing that at a $37 billion firm is a lot more fun because we have a partnership, a great Jim Gold, High Supporta, the team. They're phenomenal, and we're working together to build something special.
So you have all these solo practitioners out there working, many of whom are running $500 million, $1 billion. How do they deal with the issue of succession planning? Clients have to know, hey, if my guy's hit by a bus, I have to be able to access my money.
It's funny, I don't think clients ask that question enough, because if they did, our industry would probably look at it in a different way.
Right.
But most advisors don't have a very clean-cut succession plan, and if they do, they're not super happy with it. So if we look at it, a lot of advisors are looking to go into the next chapter of their career with next-gen advisors, and that means you have to do both. Like, this event's a perfect example. Future Proof, if you look around, there's so many young advisors that want to be a part of the next chapter of this industry. And you can't have succession without the next chapter of the industry. So if we look at these advisors that are looking for succession, it's really about identifying what's important to them, making sure that they know exactly what they're getting into when they do the transition, because that's a fear. They want to make sure their clients are well served and continuity continues. So there's so many things to think about.
Scott, I think about, and Barry, how many times we're talking about whether it's, Jamie Dimon at JPMorgan Chase or whether it was, Bob Iger at Disney. You think about it. We talk about that so much because who is in that top spot really determines the future trajectory of a company. Same thing, though, with a financial firm, right? In terms of who's running it. I thought it was interesting. I'm thinking about the Bloomberg audience. Like, if you are investing with a firm, you want to know what they're thinking, because the change at the top can impact how well your investments or how they do as a firm.
Yeah, I love the wisdom in our industry. I love the fact that there is no age that defines how good someone can be. But at the end of the day, a team approach is a great approach, because if I have a demographic that identifies, think about how you receive your paperwork. You know, if you're not getting it today with an app or a quick conversation or a fill in the blank versus the old ways where you were getting a pile of paper,
right.
You know, the generational shift is important, and it's our job to push. We push our parents in those ways. We push, you know, the next generation always needs, and then my children push me. So we have to continue to do that in the industry, and I think it's really a great thing for our listeners to think about as far as continuity. How does my plan continue when I move on? And that's what the legacy division at Steward's all about, is helping the advisors create continuity plans that matter for their clients.
So let's talk dollars and cents. Back in the before days when Fed rates were zero and RIAs were thought of as this great, reliable, almost like a preferred stock issuance, you had a great yield of 7, 8, 9% and equity upside if there was acquisitions. People were paying some pretty aggressive multiples. Now that rates are much higher, what do you see in the landscape for acquisition? Is it still 10 and 15x? What does it look like?
Yeah, you know, you go through this process and you learn very quickly. There's a lot of inflated numbers that get thrown around, and they can throw that around and then decrease your EBITDA, and it still looks really, really good, but it's not the same number. So I think the numbers are real. I think you just have to know where you fit in. Are you more of a single practitioner, with $1 billion under management and having that consistent cash flow that's fairly low number of staff members? You're going to do pretty well, but not as well as the enterprises. You know, the $5 billion firms are very attractive to us. We should talk. But these are the things. These are the things that are the most
Have
interesting.
you done your legacy planning?
We literally get calls every other week
from
PE, going back for way back when. And I remember having a conversation before we launched this, and I'm like, listen, we have this little project I can't tell you about. It's going to affect our valuation. I can't even talk to you about it. We have a different growth rate. We have a different business model. Every conversation we've ever had has always been like, well, thanks. Nice chatting. We'll get back to you. It's like, besides, I am having too much fun.
Right.
Yeah.
Why? I will freely admit, I have the best gig in all of finance. I get to work with Carol. I do stuff like this. I sit down in the office. I just had David Rubenstein in my studio for an hour and a half. Who does that? Why would I ever want to give that up?
I don't think you have to. I think the key is, and what you have to pay attention to, is the life option. What you're talking about is your life is great. How do we maintain that lifestyle? And I think what's different is you'll never get a call from us.
Right.
I'm not recruiting. We're attracting people because we're focusing on what's important to you in your life. And that's what we're going to focus on in the next chapter. That's what the legacy division's all about. And I think in our industry, you're doing all the right things, all the things you love. What we have to pay attention to is when does that end, and how can we make sure that it doesn't end in a way that we're not happy with? We want to make sure that continues even for our clients, and the fun continues.
So let me push this back to you. You're $37 billion. I look at shops like Shirl Penny's Dynasty. They're over $100 billion. Where do you want to go? What are your goals?
Yes, so our company's goals are to continue to grow. I was the first acquisition, so the beautiful thing is we are now acquiring a significantly high number of practices, and we've entered that space. We're still traditionally growing by recruiting the way that the Smith Barney guys always did, by just attracting great advisors and breakaway advisors. And I see us going from $30 billion to $100 billion very quickly. And I think as a partnership, that's very exciting for every single person that owns shares in this company, and everyone in our company owns shares, from our admin to our marketing teams to the advisors.
How does that impact culture?
I think it impacts culture in a great way, because being new to this entity in the last 9 months, what I could tell you is the sharing is significant. If you're doing something great, there's no hesitation for you to share it to somebody else, because if your practice is doing great and I share it with you, we're now elevating the entire firm's value. And that to me is something special. And I come from the old Edward Jones days where I started, and it was something that having partnership at Edward Jones was something really special. It was being a part of something bigger. Anytime you're a part of something bigger, a community, if you will, you're going to have a really great opportunity with culture.
Plus that ownership mindset permeates everything everybody does.
Yeah, it's an ownership mindset, which means you're not overspending in the wrong spaces. You're paying attention to, if I want to fly first class, I can upgrade, but it doesn't have to be at the firm's expense. There are things that you think about because you're trying to elevate the value of the firm and not just you.
Because what you do impacts the value of the firm, the success, but you also get a piece of that, so it'll impact how much that you have of that.
It's very special.
I think about a Bloomberg audience who's listening to this conversation. I have to say, I don't know that I had ever thought about legacy at all of these firms, and it was interesting kind of prepping for this event. So what do you think about the Bloomberg audience, investors who are listening to it, what they need to take away and think about?
Well, I'm a build better kind of person, meaning that if I think there's a better way, I want to know it.
Yeah.
If I'm a client sitting across from my financial advisor right now, I want to know what they're doing that's innovative. If we're only doing the same old thing that we've always done. Now, look, I'm not saying blow up plans. I'm just saying pay attention to the team, pay attention to the demographic, pay attention to the things that they're bringing back. And these are the things that if I'm listening and I'm thinking about this sitting across from my advisor, I'm just paying attention to something as simple as a succession plan. Is it written? Is it confirmed? Or is it just floating in the air like most groups? And that's something that I think is really important, because my financial plan that you continuously tell me to maintain,
right,
markets up, markets down, I maintain my plan. I need to know that you're maintaining my plan if you're here or you're not here. And it's very impactful.
It's so logical, right?
It's really most overlooked aspects of running a business. I can't tell you how many firms this is a giant gaping hole that they have to respond to. So if someone comes to you and says, look, we're not looking to sell, but we want to learn a little bit more about succession planning and we want to have a conversation, maybe down the road we're ready to do this. How do you work with firms like that?
I think about 30 seconds.
Yeah, I think at the end of the day, it's all about building relationships. So what we're doing is we're building a relationship to learn about your business, learn about what you're trying to accomplish, and how we can help you actually attain that. Most importantly, we understand your story, and we help you reach that goal that you're aiming towards, whatever it may be.
Scott, is the trend 10 seconds for much more bigger firms or smaller firms, or a little bit of both?
I think the trend is moving in an upward progression on both.
On both. All right, good stuff. Thank you so much.
Thank you so much for having me.
Really appreciate it. All right, Scott Danner, head of the Legacy Division at Steward Partners.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, about 18 minutes left in the trading day. It is time for the Drive to the Close. I'm Carol Massar along with Barry Ritholtz. We are live at Future Proof in Huntington Beach, California, and we've got, 2 days for that Fed decision.
That's right, Wednesday, the last day of this event, and I'll be halfway home when they come out and announce.
So you're going to get home and have to wait to read about it on the Bloomberg?
No, I'm waiting for Delta Wi-Fi. As long as I have Wi-Fi on the plane, I'll track it in real time.
That's a really good point. All right, so let's get to our guests because we're going to talk a little bit about the trade. Amanda Rebello is with us, Managing Director, Head of Xtrackers Sales at the DWS Group, the Global Asset Manager. You might remember they were formerly Deutsche Asset Management, a little bit of a history lesson, part of Deutsche Group until 2018 when DWS became a separate entity. Welcome, welcome.
Thank you very much for having me.
How are you?
I'm doing really well. It's hard not to be doing well when there's sunshine and you're at the beach in California. So
not the worst setup to talk about investing in markets, right?
Exactly. Well, it's hard to remain focused, but I think so many stimulating conversations here that are giving us a lot of ideas. So,
what specifically? I am curious. You could. There's a good mood, and I know it's California, and I know it's the beach, but it's interesting. It does feel like people are pretty optimistic. How do you see the outlook right now?
Yeah, I think, we were just talking about everyone waiting in anticipation of Wednesday, and I think that's been a major talking point in all of the breakout sessions that we've had this morning. Everyone's definitely in wait and see mode as we see in the markets. And I think that we've had a lot of, great momentum in the markets over the past couple of years. But the number one thing that my team and I were speaking about to investors, prospects, clients is what's your view or your take on your current allocation to the Magnificent Seven? It's top of mind for everyone. Everyone is perhaps too long. Everyone is very aware of that, but at the same time, there's still this kind of FOMO aspect as well, especially after the dips last week, people wondering, should they still remain in? Should they top up? Should they actually rotate away to non-market cap weighted exposures within US equities? Should they even diversify to international equities? And especially given our German heritage, we've kind of been a go-to for a lot of investors on that side.
So what do you make of how the market has behaved since the Magnificent Seven has kind of stumbled?
Mm-hmm.
You know, a lot of bears said once the generals trip, that's it, it's all over. And instead, it seems like the market is broadening out and there's more participation. That tends to be healthy, doesn't it?
S&P 500 equal weight hitting a record, all-time high today.
Absolutely. We actually have this fund in Europe, and we love it. It's been one of the top sellers in our UCITS range. From our side, within the US range, we kind of are thinking more about how can we provide some more sector diversification. I think everyone is very long tech, but like you said, Barry, it's really good to see that at least you're not just in just a few names. Now it's extending kind of along the tail, which is very healthy. You know, it's really funny to see that the ETFs were first launched globally in 1990, and you know, one of the key elements of them was the diversification trade, so have diversification in just one CUSIP or ISIN, and that's very much like coming back. You know, it's ever relevant, which is fantastic. What we're really liking at the moment from that diversification perspective is to still not have too much propensity to just one sector, but obviously there are some sectors which are more important than others. We like the equal weight, but at the end of the day, it's just thinking about the number of names in each sector.
Mm-hmm.
So maybe, you know, there's a version 2.0 that we're trying to work on our side. But what we really liked is about picking the winners within each sector. So we've got our S&P E fund. It's just crossed its 5-year mark, its anniversary. And what's really good is that it's sector neutral versus the broad-based benchmark, but you're actually picking the winners within each sector based on ESG scores from S&P, the index provider.
People still want ESG?
Well, the thing is, you know what? It's still a lot of cynics, and I think that a lot of people have thought, oh, it just equates to environmental, but in reality, the social component, but more importantly, the governance component, this is what stock analysts are looking at anyway.
Which seems to be more easily to measure.
Exactly, yeah. There's so much data and everything that we have, so, you know, just to encapsulate it in an index is very easy. I think frankly, you know, all of us are looking for the unicorn is always to outperform the S&P 500, and actually this fund is doing that. So it's outperformed by about 1.55% per annum since inception.
Wow.
Which is incredible, and it's not been by playing any sectors or anything like that. So that's really positive.
The governance side seems to act as a risk screen to pull out some really bad actors before they start acting badly.
Exactly, absolutely. So it's usually typically a buffer on the downside, but what's been really great to see with this outperformance is that even in the market that has rallied over the last 5 years, you also captured more upside as well, which is fantastic. So what you end up with is a lower downside capture and then a higher upside capture, which is what we're all striving to do in our industry.
That's how you outperform.
Exactly, absolutely.
How does AI play into your world in terms of what investors want, but also how you guys actually create funds, create investment vehicles?
Yeah, we love AI. I mean, one of the greatest things that we're most proud about at DWS is that we actually have the largest AI fund in the world. It's our UCITS XAIX. And being a global player, we're able to kind of take ideas from both sides of the Atlantic. Maybe one of the reasons why I came over from the UK to the US, and then one day I go back maybe. But this fund is, we've just launched it in the past couple of months here in the US for US investors, and great to have this fund. There are a number of different funds already in the market, but what's very different about this fund is that it's forward-looking. So we actually, it's a bit meta in fact, we use AI to capture AI, so we use natural language processing to identify the patent universe, and so we're thinking then about which stocks are going to benefit more, are going to have better forward-looking revenues, which obviously then helps with the valuation of the stocks rather than just which are already existing players in the market.
What's the vehicle for this? Are you using ETFs, mutual funds? How does it roll?
We're using ETFs, and very typically speaking at DWS, we are launching more ETFs than mutual funds these days. Last year we launched around 7 new funds, and this year we're kind of aiming for a similar number as well, and probably next year going to 10 or so. the reason why is we're just listening to what the investors want, and the investors are saying that the ETFs time and time again are helping them with their businesses, with their investment needs and so forth. So we've actually launched our first active ETF, which I think is the real confirmation of that stance, which is our natural resources ETF, which we just launched this year, NRES, and that's been a collaboration with one of our strongest platforms at DWS, which is our liquid real assets REEF platform. So leveraging their expertise in terms of identifying equities which are very highly correlated to the commodities markets, but without taking the volatility of commodities markets.
You mentioned that you wanted to move a little bit away from the concentrated Mag 7. Any particular sector standing out? We only have about 30 seconds left.
We are really liking international equities, and especially if they're FX hedged or if there's a value component like dividends in them.
I feel like people have been talking about the international aspect for about a year.
Eventually, that mean reversion is going to kick in, but it's been a long time coming.
Nice to catch up with you. Thank
you very much for having me.
Appreciate it.
Have a good day. Bye.
Amanda Rebello, head of Xtrackers Sales at the DWS Group.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.